So, imagine you're driving down the highway,
Okay.
and the car in front of you just slams on its brakes. So you hit your brakes hard.
Right. Yeah.
It's a split-second reaction.
Hmm.
You avoid an accident, you take a breath, and you just go about your day. You completely forget it ever happened.
Sure.
But then, like, weeks later, your auto insurance premium suddenly spikes.
Yeah.
And you didn't get into an accident.
You didn't get a ticket.
Exactly. You never spoke to your insurance agent.
Yeah.
So how on earth did your insurer know about that one sudden stop?
Well, the answer lies in this this invisible, highly lucrative data pipeline that's operating just beneath the surface of our daily lives.
Yeah.
Because your car, which is basically a rolling computer these days, right?
Oh.
It logged that hard braking event,
Right.
and it transmitted that data to the manufacturer, who then, packaged it and sold it to a massive third-party data broker.
And then that broker ran it through some proprietary algorithm and fed the result directly to your insurance company.
Exactly. Without you ever knowing.
Which brings us to the focus of today's deep dive.
Mm-hmm.
A listener sent us this stack of corporate documents centered around, honestly, one of the most powerful companies you have probably never heard of.
Yeah, Verisk Analytics.
Right. They are a massive strategic data analytics and technology provider for the global insurance industry.
Yeah.
And the documents you sent us to look at, I mean, they are a treasure trove.
Oh, absolutely.
We have their Q1 2026 earnings presentation, a corporate press release, and the real heavyweight of the group, which is a remarkably dense Form 10Q SEC filing from April 29th, 2026.
But you also included a little screenshot at the top of the stack, which I love.
All right.
Yeah, it was a Cloudflare verification page from MarketBeat.com, basically asking us to prove we aren't bots before we could even look at Verisk's stock profile.
I found that detail incredibly poetic.
Right.
Like, we literally have to click on pictures of crosswalks and bicycles to prove our humanity, just so we can examine a corporation whose entire multi-billion-dollar future relies on, well, vacuuming up human behavior and feeding it into automated AI models.
The irony is just perfect.
It really is. But looking past the anti-bot screens and the really dry SEC formatting, this stack of documents reveals a legitimate corporate thriller.
It really does.
We're looking at an absolute cash printing machine that is simultaneously navigating a disastrous, $1.5 billion collapsed merger,
Yeah.
while fighting a multi-front legal war over who actually owns the data of our daily lives.
And, to understand the stakes of those legal battles later on, we really need to start with the sheer scale of the machinery here.
Okay, let's unpack this, because what exactly does an insurance data giant do to earn, what was it, $783 million in a single quarter?
Yeah, so when we look at the financials in this Q1 2026 report, they brought in total revenue of $783 million, and that represents a 4.7% organic constant currency increase, or OCC.
And just to clarify that metric for a second, OCC basically strips out the noise, right? Like
Right.
fluctuating foreign exchange rates or recent acquisition.
Right, exactly. It gives us a look at the true baseline growth of the underlying business.
So the baseline is growing. But the number that really jumped off the page for me wasn't the top-line revenue, it was the profit margin.
Oh, yeah.
They reported an adjusted EBITDA of $438 million.
What's fascinating here is that translates to a 55.9% adjusted EBITDA margin.
That's just wow.
Right. For anyone who doesn't spend their days staring at corporate balance sheets, that is a staggering number. It means that for every dollar Verisk takes in, they are keeping roughly 56 cents as profit before things like taxes and interest and depreciation are factored in.
Margins like that are incredibly rare.
Very rare. They indicate a business with almost unbelievable operating leverage and, honestly, absolute pricing power.
Right, and I think the best way to visualize how they maintain that kind of stranglehold is it's almost like a high-end gym membership for insurance companies, right?
Okay, how so?
Well, the documents note that 84% of their insurance revenue comes from subscriptions. It isn't like buying a piece of software off the shelf once. Verisk's products are the foundational architecture of risk assessment.
Oh, absolutely.
They provide the actuaries with standardized coverage language, historical claims, fraud databases, predictive risk models. If an insurance company decides to suddenly cancel their Verisk subscription, they essentially paralyze their own underwriting department.
They'd be completely flying blind. They wouldn't know how to price a policy.
Exactly.
And Verisk continuously deepens that dependency, right? They keep rolling out new, highly specialized tools so you can never leave. In this quarter alone, the presentation highlights that they introduced 7 new modules across an initiative they call Core Lines Reimagine.
Wow, 7 modules in 1 quarter.
Right. And they updated their U.S. tropical cyclone model.
Which is brilliant from a revenue standpoint. I mean, if you're an insurance company underwriting property on the Florida coast,
You cannot rely on a hurricane model from 3 years ago.
you just can't. The climate is shifting, building codes are changing, property values are fluctuating.
Yeah.
You are basically forced to pay for Verisk's continuously updated model because the financial risk of using outdated data is catastrophic.
And this deep integration ties directly into their aggressive push toward artificial intelligence.
Right.
There's a very telling quote in the press release from Verisk's president and CEO, Lee Shavel. He states that their, quote, proprietary data sets and distinctive insights are competitive advantages that allow them to introduce new and effective AI solutions into core insurance workflows.
I read that quote as a warning shot to the broader tech industry, honestly.
How so?
Well, every startup in Silicon Valley is trying to build the ultimate AI, right? But an AI model is completely useless. It's essentially an empty brain without massive, high-quality data sets to train on.
Right. The data is the bottleneck.
Exactly.
Yep.
And Shovel is telling the market that Verisk already owns the data. They have decades of historical claims, the localized risk profiles, the weather correlations. They don't need to build generalized AI from scratch.
They are perfectly positioned to inject highly specific, highly monetizable AI directly into the software that insurance underwriters are already using every single day.
It's a massive moat against disruption.
It is. However, if we dig a bit deeper into the revenue breakdown in the 10Q, the armor isn't entirely impenetrable.
Okay.
Because while the subscription side is a fortress, their transactional revenue actually dropped by 6.1% compared to the prior year.
Yeah, I spent some time parsing that drop because it seems totally counterintuitive.
Right.
If their data is so crucial, the indispensable nervous system of the industry,
Right.
why are fewer people buying a la carte? Because transactional revenue is basically when a customer pays for a specific one-time report, right?
Exactly. Like running a background check on a single commercial property or verifying one specific workers' compensation claim.
Right, so why would that suddenly shrink by 6%?
Well, the filings explain that this dip was primarily due to lower weather-related volumes within their property and restoration solutions.
Oh, okay.
Because they're comparing Q1 2026 to the prior year, which was heavily impacted by the aftermath of Hurricanes Helene and Milton.
Oh, so it's completely reactive. When a massive natural disaster hits, insurance companies are flooded with unpredictable claims. They don't have the staff to handle it, so they frantically buy extra on-the-spot reports and specialized modeling from Verisk to assess all the damage.
Exactly. But when the weather is relatively calm, that specific revenue stream just dries up. It's the nature of transactional volume. They also noted some continued competitive pressures in their auto segment.
But the critical takeaway for investors is that despite a 6.1% drop in transactional sales, overall revenue still grew.
Yes, the subscription side expanded by 7.0%, and the documents explicitly state this was driven by, quote, strong price realization in forms, rules, and loss costs.
Price realization. I love that. It's such a polite corporate euphemism.
Right.
It just means they cranked up the prices and their customers had absolutely no choice but to pay them.
Yeah, that is the ultimate test of a monopoly-like product.
Okay, so they are swimming in subscription cash. They generated, what, $326 million in free cash flow in just 3 months?
Yes.
So the natural question becomes, what do you do with all that money? Usually you either deploy it to acquire other companies or you give it back to shareholders.
And here's where it gets really interesting, because
Yeah.
this brings us to the most dramatic narrative hidden in these financial documents. Verisk attempted a massive acquisition, and when it spectacularly failed, they executed one of the most aggressive financial pivots you'll see in a quarterly filing.
The Acculink saga.
Yes.
The timeline of this aborted $1.5 billion deal is just wild. Let's break down the mechanics of what actually happened here.
Okay, so in July 2025, Verisk signed a definitive agreement to acquire a company called ExactLogix, which operates under the name Acculinks.
Okay.
It was a massive strategic play. And to fund $1.5 billion purchase, Verisk had to raise capital. So they went to the debt markets and issued 2 massive tranches of bonds. They sold $750 million in senior notes due in 2030 and another $750 million in notes due in 2036.
So they locked themselves into long-term interest payments specifically to buy this one company.
Yep.
They took out a massive corporate mortgage, signed the paperwork, had the cash sitting in the bank. But then, on December 26, 2025, literally the day after Christmas, Verisk suddenly and unilaterally terminates the merger agreement.
Yeah.
The filings note that Acculinks immediately alleged a breach of contract, but Verisk pulled the plug anyway. And when you cancel a deal of that magnitude, you can't just return the borrowed money and pretend it never happened. Right?
Oh, no. The financial friction of that cancellation is severe. Those bonds contained a special mandatory redemption provision. Because the specific acquisition they were tied to didn't close, Verisk was legally obligated to redeem all $1.5 billion of those notes by January 6, 2026.
The penalty for this is buried in the numbers, and it is staggering. They took a $33.9 million loss just to extinguish that newly issued debt early.
Right.
Because they were forced to pay 1% redemption premium to the bondholders, which is $15 million straight out the door. Then you add in all the unamortized costs, the banker fees, the legal fees, the underwriting costs of setting up the debt in the first place.
Yeah.
Nearly $34 million basically vanished into thin air, and they don't even own the company they wanted to buy.
It is a painful operational blunder. But the true story here is the speed and aggression of management's response.
Right, pivot.
Exactly. Because they had publicly promised Wall Street that they were going to deploy $1.5 billion to generate value. With the Acculinks deal dead, they shifted gears entirely. In February 2026, they executed a $1.5 billion accelerated share repurchase program, or ASR, with HSBC and Wells Fargo.
Okay, let's explain the mechanics of an ASR, because it's completely different from a company just slowly buying its own stock on the open market, right?
Right.
In an ASR, Verisk essentially signs a forward contract with these investment banks. Verisk hands over $1.5 billion up front. In exchange, the banks immediately deliver a massive chunk of stock back to Verisk, in this case, nearly 7 million shares.
Yeah.
And then the banks spend the next several months slowly buying those shares back from the open market to balance their own books. It instantly reduces the number of outstanding shares, which artificially boosts the value of the remaining shares.
It's a very blunt instrument for projecting corporate strength.
Yeah.
But the most fascinating detail is how they funded this stock buyback. Because they had just been forced to return the original $1.5 billion, they had to go back to the debt markets.
Wait, again?
Yes. They issued new 2031 notes, new 2036 notes, and took out a massive term loan.
I really want to push back on the optics of this because it feels incredibly defensive.
How so?
Well, they borrowed $1.5 billion to buy a company. They backed out of the deal, paid a $34 million penalty to cancel the loans, and then immediately went out and borrowed another $1.5 billion just so they could artificially inflate their own stock price.
Yeah.
Is this actually a sign of a highly agile management team confidently returning capital? Or is this a frantic, incredibly expensive scramble to keep shareholders happy so they don't revolt over blowing a major acquisition?
Well, management is working very hard to frame it as a position of strength. Verisk CFO Elizabeth Mann is quoted in the press release emphasizing that they executed the ASR while continuing to invest back into our business.
Right.
She highlights their confidence that revenue growth will return to levels consistent with their long-term targets. And if you combine that with the fact that they maintained a 50-cent per share dividend, the message they are sending to the market is clear.
Which is what?
Basically, the Acculinks deal was a misstep, sure, but our core cash-generating engine is so powerful that we can absorb the penalty, restructure our debt entirely, and still return billions to our investors.
I mean, executing a $1.5 billion stock buyback is certainly a loud way to project confidence. But that confidence only holds up if the core business remains untouchable. And when we transition from the financial metrics to the back of the 10Q, specifically the commitments and contingencies section, we see that the core asset Verisk relies on is under massive structural threat.
Yeah, because when your entire business model is built on harvesting personal data, safety is an illusion.
Exactly. They're aggressively protecting their stock price, which makes sense because the Acculinks deal isn't just a dead deal, it's an active lawsuit. And speaking of lawsuits, the legal disclosures in this filing outline an incredibly risky operating environment.
Right, because the Acculinks situation is far from resolved. After Verisk terminated the deal, they filed a declaratory judgment action in Delaware Chancery Court to legally validate the termination. Acculinks responded with counterclaims, the court expedited the litigation, and they're heading for a full trial in June 2026.
So they're actively fighting a former acquisition target in court. You know, corporate M&A lawsuits are ultimately just arguments over money. The lawsuits that really caught my attention, the ones that expose the fundamental vulnerability of Verisk's business model, are the class actions involving consumer privacy.
Oh, definitely.
Let's go back to that scenario we started with. The car secretly reporting your driving habits. That isn't just a hypothetical.
Yeah.
That is an active, massive piece of litigation detailed in this 10Q.
Yes, the telematics litigation. If we connect this to the bigger picture, this represents a direct collision between Verisk's data ingestion model and growing global privacy standards.
The mechanics of this lawsuit are fascinating. Consumers have filed a wave of class action lawsuits targeting massive auto manufacturers like GM and Hyundai.
Yeah.
But the plaintiffs didn't stop at the car makers. They also sued the data brokers, specifically naming LexisNexis and Verisk.
And what's the core allegation there?
The allegation is that these modern vehicles are tracking highly specific driver behavior, telemetry, hard-braking, rapid acceleration, late-night driving hours. The manufacturers are allegedly transmitting that granular data to Verisk, who then feeds it into risk models sold to auto insurance companies.
Right.
And the plaintiffs claim this entire data lifecycle occurred without the driver's knowledge or explicit consent.
Now, we must emphasize that these are allegations, and the cases are in their early procedural stages. The companies involved, including Verisk, have filed motions to dismiss these claims.
Of course.
But mechanically, this litigation strikes at the heart of how Verisk generates that 55.9% profit margin. They rely on uninterrupted, massive pipelines of data flowing from third-party sources into their algorithms.
Data is the new oil. Right.
Right.
But as we see in this 10Q, oil spills are messy and really expensive. I might love the fact that my insurance app gives me a discount for safe driving, but that is an opt-in relationship.
Right.
If consumers discover that their cars are essentially surveillance devices cattling on their rolling stops to a data broker, the public backlash could force regulators to sever those data pipelines entirely. How does a company like Verisk handle structural risks like that?
Well, it is an ongoing, incredibly expensive battle of attrition. If your product is information, the legal boundary defining who actually owns that information is your permanent battleground. We see another perfect example of this vulnerability in the Atlas Data Privacy Corps lawsuit.
Oh, right, the one involving Daniel's Law.
Yes, which revolves around a statute in New Jersey.
Let's break down the mechanics of Daniel's Law because it shows how quickly legislation can disrupt a data broker. The law was enacted to protect judicial and law enforcement officers by granting them the right to demand that their personal information, like home addresses or phone numbers, be scrubbed from public disclosure or commercial databases.
And in this specific lawsuit, an assignee representing nearly 20,000 covered officers is suing Verisk.
Wow.
They're alleging that Verisk failed to properly comply with requests to stop publicly disclosing or redisclosing their protected information. The plaintiffs are seeking a statutory penalty of $1,000 per violation.
Wait, $1,000 per violation for 20,000 officers. That's $20 million just in statutory penalties, if not more.
Exactly, alongside punitive damages and the appointment of an independent expert to ensure Verisk overhauls its compliance systems.
Think about the scale of that. And Verisk is naturally fighting this tooth and nail. The filings show them joining in opposition to consolidate cases, moving to dismiss, trying to stay the case.
Right.
Because when your entire business relies on aggregating standardized data on a massive scale, anonymizing or selectively scrubbing tens of thousands of individual records across interconnected databases isn't just a legal headache. It is a massive logistical expense that directly threatens your profit margins.
And their legal exposure isn't even limited to disgruntled consumers or privacy advocates enforcing state laws. They're also facing aggressive litigation from other massive corporations over proprietary data.
The J.P. Morgan Chase lawsuit really highlights the sheer breadth of this minefield. JPMC is suing a Verisk subsidiary called Argus, alleging the misappropriation of trade secret data. JPMC is demanding lost profits, royalties, and an injunction. When one of the largest banks in the world accuses your subsidiary of stealing the data that powers your analytics, that is a serious threat to the integrity of your product.
And just to illustrate the incredibly long, unpredictable tale of corporate liability when you deal in global information, we have to look at the strangest detail from the 10Q, the tax investigation.
I could not believe I was reading that part.
Right. Verisk received an indemnification claim from the current owner of a healthcare analytics subsidiary. Verisk sold this subsidiary a full decade ago, back in 2016.
From 2016.
Yeah. And yet, 10 years later, Verisk is being pulled into an ongoing, complex tax investigation by the government of Nepal regarding pre-closing tax liabilities.
It really drives home the point that in the data business, your past transactions never truly disappear.
What is critical for you, the listener, to understand as we review these filings is that Verisk explicitly states they are currently unable to estimate the financial liability of these cases. The litigation is either too early in the process or the potential damages are simply too complex to quantify.
They haven't put a dollar amount on the potential losses. They are essentially telling investors, we are fighting all of this, but we have absolutely no idea how much it might ultimately cost us.
But the synthesis of all this litigation, from the expedited M&A trial in Delaware against Acculinx, to the everyday drivers alleging surveillance in the telematics case, to the thousands of law enforcement officers in New Jersey, to major banks and foreign tax authorities, it shows that this legal warfare is just the hidden cost of doing business when your foundational asset is the world's information.
So what does this all mean for you? Let's bring all of this together. We started this deep dive looking at a company that appears to be an absolute financial juggernaut. Verisk is the highly profitable, AI-driven cornerstone of the insurance industry. They command incredible pricing power, keeping nearly 56 cents of profit on every dollar they make, largely because their subscription data is the indispensable architecture of how global risk is calculated. They are generating hundreds of millions in free cash flow.
Yet, beneath those pristine 55.9% margins, the machinery requires constant, expensive maintenance. They are navigating the chaotic wake of a billion-dollar broken deal.
Yeah.
They're absorbing millions in financial penalties and pivoting billions of dollars in new debt just to execute a massive stock buyback, all to keep the market confident that the engine is running smoothly.
And most importantly, they are fighting aggressive, multi-front legal battles over the very data pipelines that make their company valuable in the first place. Whether it's consumer privacy laws, breach of contract disputes, or trade secret allegations, the foundation of their business model is under constant attack.
The takeaway here is that you are an active part of this ecosystem. Every time you drive a connected car, every time you sign a new insurance policy, or even when a coastal weather model predicts a storm's path over your neighborhood, your data is likely feeding into the very algorithms and the revenue streams of the company we just analyzed.
Which leaves us with a final, provocative thought to ponder. Something that isn't explicitly written in the SEC filings, but is clearly visible when you step back and look at the broader landscape.
What's that?
As artificial intelligence becomes completely dependent on massive, proprietary datasets to function, a new reality is emerging. We tend to assume that the ultimate winners of the AI revolution will be the tech companies that build the smartest, most elegant algorithms.
Right.
But what if that assumption is wrong? What if the true winners of the AI age are simply the companies like Verisk, who are willing and financially able to endure the most grueling, expensive, and endless legal battles to keep their data pipelines open? Because if the perfect, predictable algorithm is just an illusion hiding a mountain of invisible human data, somebody has to be willing to fight in court to keep that data flowing.
That is a fascinating way to look at it.
Thank you to our listener for sharing these incredible sources and sending us down this rabbit hole. We will catch you next time on The Deep Dive.